All right, hi guys. So it's time for another market update. It's the 1st of August. So let's begin with looking at the US markets, S&P 500. Let's look at the technicals. Let's look at the charts to begin with. So on daily candles, let's start with daily candles. Year to date, the market's up about 17%. So it's way above the average. If you look back at the last 30 years, the average return of the S&P per year on average is about 10%. So this year we're up 17% so far, which is great, way above average. But always remember that whatever the market gives is going to take back, right? So if it gives 17%, which is 7% above the average, eventually it's going to take back 7%. Now, when that happens, no one knows. But just understand that you can't get 17% every single year. Eventually, the market has to take it back so that you get that long-term 10% average a year. Okay, so you can see that the market continues on its very clear uptrend. I keep saying that no one can predict short-term price movements. We can't predict the future. But it's important to look at the trend because the trend is your friend. When a price is on an uptrend, the probability is that prices will continue to move in the direction of the trend until there's a change in trend. So as of now, we are on an uptrend on the S&P, which means that the market's bullish and the path of least resistance is upward and onward, or onward and upward, whatever you call it, right? Okay, so very clear uptrend as you can see, and very distinct wave patterns. We've got a wave up, wave down, wave up, wave down, and so on and so forth. And so far for the year, you can see the 50 moving average has been acting as a pretty strong support. It always finds a way to bounce off that 50 moving average. And of course, this won't continue forever, but for now, that's the pattern that we're seeing. So we just bounced off that 50 moving average again a couple of days ago, and we made a new high at 4429, and it looks like, well, it's hard to say, right? It could still go higher, right? We are right now on an impulsive wave up pattern. It could go higher, or it may retrace back down again. No one can predict for sure. But again, right now the market's bullish. 50 moving average, above 150 moving average. Prices remain above the 200 moving average. So very, very clear uptrend. So if you're thinking of buying into the S&P using the ETF, where would be a place to add shares? You always want to add on a wave down near the support level, which would be the closest support, obviously, would be the 50 moving average, which would be about there, right? 4286 would be a place to add when it retraces back, okay? Now, if you take a longer term time frame, if you take a look at the weekly candles, now let's go from daily to weekly candles. You can see on the weekly candles, there we are. That's the very nice trend. And on weekly candles, you can see that when prices tend to have a bigger retracement, they find support at the 20 EMA, which is the red dotted line. Which means if we get a bigger retracement than a small retracement, prices could end up at that red dotted line. So I like to draw another line over there to say, hey, this could also be a potential support if we get a big retracement. Ready, go, boom, boom. Okay, there we go. 4,002 would be, I would say, a medium-term retracement. All right. Now, if you take a look at the longer term charts, if you take a look at like the monthly candles on the 10-year time frame, ooh, looks a bit scary, right? Does look a bit scary. Why? Because remember that the market breathes out, breathes in, breathes out, breathes in, breathes out, and eventually it will have to breathe in back to the moving averages. It always has to come home, right? And you can see that right now it's like breathing out. Eventually it's going to breathe back in, but no one knows when. It could keep breathing out, but eventually it's going to breathe back in again, right? I'm not saying that we're going to have a big crash. I'm not saying that. Sometimes it could go sideways and the moving averages would then catch up, but eventually it has to go back near the moving averages. But you can see that on the long-term time frame, it does look like it's getting pretty far from those moving averages. So like I said, if you're buying into the S&P like an ETF, don't put all your money in at one time. It's always good to buy in tranches. So if you want to buy, say, 100 shares, buy 25 shares first, or 33 shares first, right? Average in, because when we do get the big retracement, it's not a question of if, it's a question of when, then prices could come back down to this, at least this moving average here. Let's draw a line there at about 3663, which is pretty far down actually, right? But on a longer term time frame, it has to come back down to that level eventually. All right, so just bear that in mind. So those are the technicals. Now again, let's look at the fundamentals, and let's begin with a rough valuation of the markets. Now, I've said many times before that the overall market, the S&P 500, the Nasdaq, seem very expensive from a price to earnings multiple perspective, from a PE perspective. I've said this many, many times before, nothing new. In fact, as of this month, the PE ratio is up even higher, right, at 38.3 times earnings. If you compare this to the 20-year PE average, it's 17 times earnings. Right now, it's like 38 times, so it seems really overvalued, right? But again, there are a few mitigating factors I've said many times before. That's why I'm still in the markets. I didn't sell out. I'm still in the markets, right? The limitation of PE ratio is that it doesn't take into account the growth of the earnings. So when companies are able to grow at higher earnings, they deserve a higher multiple. Historically, companies' earnings growth have been about 8 to 10% a year. So if a company is growing its earnings at 8 to 10% a year and the price to earnings ratio is like 17 times, then that's expensive, right? But nowadays, companies, especially the tech companies, their profits are growing at 100% a year. Alphabet, which is Google and YouTube, they just announced their results. Their profits grew at about 100% over last year. Same thing with Facebook. Facebook announced earnings grew like 120%. So when a company is growing its profits at 100% a year, of course that can't go on forever, but if it's growing 100% a year, then a price to earnings ratio of 38 times actually now looks relatively cheap, all right? So that's the limitation of PE. So that's one mitigating factor. The other mitigating factor again is if you look at historical PE, it's based on higher interest rates because stocks in a way have to compete with bonds, okay? But right now again, the yields on bonds are so low that stocks actually still look cheap relative to bonds, and that's why people are still rotating money into the stock market because it offers a better deal than the bond market, hence supporting the argument that stocks are still relatively cheap versus bonds, okay? But so what I'm saying at the end of the day is that the stock market is not insanely overvalued. It's not insanely priced, as some people put it. It's not a bubble, in my opinion, but it is not cheap. It is relatively expensive, all right? But I have said many, many times before, within this expensive market, there are pockets of industries. There are pockets of companies that remain good value. And these are the ones I'm still holding and I'm still buying shares consistently every month, right? So for example, within technology, Salesforce is still undervalued. Microsoft is still undervalued fundamentally, although the price is a bit extended. I would wait for retracement, but fundamentally it is not expensive, Microsoft, right? Healthcare, a lot of healthcare stocks are still reasonably priced, like United Health, BDX, and specifically the biotech industry is undervalued right now. Now, I don't buy individual biotech stocks, as you guys know, but I recently bought more of the biotech ETF, ticker symbol XBI. Industrials like Boeing are fairly priced. I just bought more Boeing a few days ago. As some of you guys know, 3M is fairly priced as well. Now, last month, I mentioned that consumer staples like Pepsi, like Procter & Gamble were undervalued, but no more, right? In fact, in the last month, these defensive stocks, these staple stocks like P&G, like Pepsi, for example, have suddenly shot up like crazy. So now they are overvalued. So I'm not mentioning that anymore, right? A few consumer discretionary stocks are also fairly priced, like Lowe's, for example, the home improvement company, Booking, which is the largest tour agency company in the world, and Amazon. That's right. So Amazon recently announced their earnings, and they beat on the earnings report, but their revenue was slightly lower than expectation. As well as they said, hey, this growth we are seeing, we don't expect it to grow as fast next year. We are lowering our forecast. So the market freaked out. Oh my God. So Amazon dropped like 7% from the high, which I think is great because I started buying more shares because Amazon is now cheap again. It was getting a bit expensive, but now Amazon is cheap again from a fundamental perspective. So here's a summary of the key events that took place in July. So first we had the FOMC meeting, which is the meeting of the Federal Reserve in the US, the US Central Bank, and they committed that, hey, we're going to continue to pump in liquidity into the system. We're going to continue our asset purchase program of buying treasuries and mortgage-backed securities of 130 billion per month. So in other words, they are still pumping money into the system, and they've got no intention of raising interest rates before the expectation in about 2 years, right? So that's one thing that supported markets. Second thing is that if you look at GDP, now real GDP actually grew at 6.5% in the second quarter of this year. And nominal GDP, now the difference is nominal GDP includes inflation, whereas real GDP strips out inflation, right? If you look at nominal GDP that includes inflation, nominal GDP is actually 5% higher than in the fourth quarter of 2019, which is pre-COVID. In other words, now the US GDP is higher than where it was before COVID started. All right, so you can see GDP was growing, and that was COVID, and right now we are here. We are 5% higher than where we were. So in other words, the economy is really getting along really well, right? GDP is higher than pre-COVID. On an individual household level, how are people doing, right? People's net worth have been growing, not just the rich, but across the board, right? And not only that, but if you look at the financial obligations ratio, this is a measure of household debt, service payments as a percentage of their disposable income. So in other words, out of people's profit, how much are used to pay debt, right? And you can see that it has dropped to a record low of 12.88 from 15.28 at the fourth quarter of 2019. So in other words, you can see that right now the debt obligations of households in America is really much lower than pre-COVID. So they've got less debt, more disposable income, they can spend more money, and that would be a plus for the economy, right? By the way, these are all from briefing.com, so you can check out that website. The charts and the sources are from briefing.com. So the question is this, right? Economy is growing, economy is recovering. Is that good for the stock market? Remember, I've said this many, many times in my previous lessons that the stock market is not the economy. In fact, the stock market is a leading indicator of the economy. So remember this very, very important chart over here. The red line is the stock market and the green line is the economy. So obviously people always ask this question, hey, where is the market top? Because once the market tops, I want to get out, or I'll get out before we go into the next recession or the next bear market, right? So where are we right now? Right now, I would say that we are still in the early recovery stage. Well, between early recovery to full recovery. We're not at full recovery yet. Now, remember, when the economy is at full recovery, that's when you sell all your damn shares, right? Because when the economy, the green line, is at full recovery, that's when the stock market goes into a recession. That's how it works, right? Because the stock market always moves ahead of the economy. So where are we right now? Right now, I would say that we are somewhere here, okay? We are in between economic early recovery to economic full recovery. We're somewhere in the middle here. right here. All right. So in other words, right now we are not at the top yet, but we are not at the bottom as well, right? We are, getting to the top now. People ask, how long would it take to get from here to here? All right. Is it like 1 month or 2 months? No one knows. Okay. So this could be 6 months. This could be 3 years. This could be 5 years. There's no definite timeline. But if I were to make a guess, I would guess that we would still have about 3 to 5 years to go, right? 3 to 5 years to go before we hit that top. But again, it's just a guess. No one knows, right? Now the question would be, how would I know the economy is at full recovery? How would I know that? Okay, one clue is to look at unemployment rates. That's right. When the economy has fully recovered, unemployment would be at the all-time low, right? So generally, when unemployment rate drops below about 4.7%, then that means that the economy is fully recovered. And that means that we could be getting near the top of the market cycle. So where are we now in terms of unemployment rates? Let's take a look at this. In fact, this is a chart showing you the relationship between unemployment and the S&P 500. So when is the best time to buy stocks? When it's at the bottom, right? When stock market's at the bottom of the cycle. And that is the time when you want to buy stocks. And the time you want to sell stocks is when the market's at the top of the cycle, right? Now, if you take a look at the last market top, that was here. This was the top before the financial crisis. Can you see that? And can you see that at the market top, and again, bear in mind that this is the S&P 500, the one in orange, right? Look at the purple line. The purple line is the unemployment rate. So notice that the market tends to top when unemployment bottoms, right? And you can see here unemployment below 5%, about 4.5% here, all right? So that's why I say when unemployment gets really low, it means economy is fully recovered, and that's when the market tends to top out, okay? So we're not there yet, right? So as of now, the unemployment rate is at 5.9%. So we still have quite a number of people unemployed. Once that drops to like below 5% or like 4%, full employment, that's when the market may top out. May, right? No guarantees, but I'm looking at that, okay? And again, you can see over here, when is the best time to buy stocks? That was the best time to buy. This was at the bottom of the crisis, right? And the best time to buy stocks is when unemployment is at a high. Can you see that? So you got to do the opposite of everyone else. So people think that, when unemployment is high, you should sell stocks. No, when unemployment is high, you buy stocks. You do the opposite of the entire market, right? So you can see here, right, when unemployment rates hit above 10%, right, that means a lot of people are unemployed. That means, economy is doing really badly. That's the time to buy stocks, because then you buy stocks when they're really cheap. And when unemployment is really high, what does the Fed do? The Fed will save the day. They'll pump money into the system. They will lower interest rates, and then hallelujah. So if you guys remember last year, I bought stocks in March and April near the bottom. Why? Because unemployment, see, when unemployment shot up above 10%, I said you got to buy stocks. And that's how we managed to buy stocks. That's how we managed to buy near the bottom last year, and then hallelujah, right? So that's what I'm looking at as well. Okay, now let's do a market update on China. So what has been happening in China for the last couple of months is that the Chinese government has been cracking down on many companies, especially the technology companies, because they have been very naughty, all right? They have been playing dirty. And so the government feels that, you can't play dirty anymore. It's hurting the whole industry. So I've got to come down and lay down the law and punish you guys. So how have they been naughty, right? So the first thing is a lot of these Chinese tech companies who are monopolies, right? You got basically Tencent, Alibaba, and ByteDance that owns TikTok, right? So they've been very naughty because they have erected a lot of walls between them and engaged in a lot of unfair monopolistic practices. So for example, Like in China, um, if you find a good deal on Taobao, Taobao is owned by Alibaba. Like you say, okay, there's a good deal to buy something, and you want to share it to your friend who is using Tencent's WeChat app, you can't share it, right? They will block the link. So they block each other. So if you find something good on Alibaba, you can't share it on Tencent. You find an interesting video on TikTok, you can't share it on Alibaba. So they block each other. And that's unlike the West, right? Like in the West, you find a good YouTube video, you can share it on Facebook, right? You can share something you found on, again, on Google, you can share it to Facebook as well. So, it's open borders. But in China, they block each other, and the Chinese government felt that that was not healthy for the entire market, and it's not fair for the consumers as well. So they forced them to stop this unfair practice of blocking each other. And now they want Alibaba and Tencent to work together so that it becomes more vibrant, it becomes more dynamic an industry. So that's one example. Second example of how they've been playing real bastards is this. Like, for example, Alibaba. See, Alibaba is kind of like Amazon and eBay together, right? And they tell their merchants, if you sell on our Alibaba stores, you can't sell on JD.com. You can't sell on Pinduoduo, right? So they create all these walls. Unlike in the West, as a merchant, I can sell on Amazon, I can sell on eBay, but in China, they block each other. And again, the Chinese government said, that's not right, that hurts the consumer, so you're a bad boy, cane them, right? So stop doing that. So they stop these exclusive merchant agreements and so on and so forth. If you ask me, I think it's good for the industry. It is good for the people. And in the long run, will it hurt Alibaba and Tencent? No, it won't hurt them. Why? Because they're already so big, they're so dominant. They don't have to play dirty, but they're still playing dirty, right? So I still love these companies, right? Although they played dirty for a while. Another thing would be some of these companies, they collect a lot of personal data from all their citizens, right? All these data collection and all this big data, some of them have not been managing the data well. And that could cause a lot of national security risks as well as personal privacy issues, which is what happened in the US to the Facebook Cambridge Analytica scandal, where Facebook got all the data from the US citizens and they misused it and they were fined by the US government. So China doesn't want the same repeat, doesn't want the same thing happening to their tech companies. So that's why they went after Didi. Didi is the ride-hailing app. It's like the Uber of China, and they collected all this data of all the Chinese citizens. So they know, for example, the Chinese citizens, their behaviors, right? What time they wake up in the morning, what time they leave work, what time they go back from work, where do they travel to, and all this very sensitive data. In fact, they were tracking the government employees, and they know which government employee went to work at what time they went home, who's working harder, and the government freaked out and said, how can this private company get all our data? It's going against national security risks. They are listing in the US, and this data could fall into foreign hands. No. And so they told Didi to not proceed with the IPO until they closed the loophole of how they were using all this data. And Didi basically said, F you, we are going ahead with our IPO, and pissed off the government, so they suspended all of Didi's apps. So basically, if you ask me, that's what happened, all right? So let's do a quick timeline of events in China. So it all started when Jack Ma pissed off the government when he accused them of stifling innovation in the financial sector. So the government started with Alibaba by halting their Ant IPO. And Ant is like their fintech business, right? It's kind of like their PayPal, right? So the government halted the IPO for these financial violations. Now it looks like now the IPO could still be on. They could still be listing Ant, but at a smaller valuation after the government has chopped up their business, okay? So it's still going ahead, right? And they fined Alibaba 2.8 billion for unfair practices of, again, restricting merchants from doing business on rival platforms. All right. So if you ask me, at the end of the day, does this really affect Alibaba's economic moat? Does it affect their ability to dominate the industry and to make money? No. If you ask me, yes, it hurt them a bit, but long run, Alibaba, after all this is over, after the crackdown is over, they will emerge as strong or stronger. Okay, so in fact, Alibaba right now, the share price has gone down so much. To me, it is irrational because it is still worth, in fact, it's worth more than what it was last year based on its sales and profits and all those things. So to me, on Alibaba, these regulations, as of now, unless there are new regulations, but as of now, impact is minimal on its fundamentals. Next, let's look at Tencent. So Tencent in China is the world's biggest social media company. They are like Facebook and Twitter and WhatsApp all roll into one. And Tencent is also the biggest online gaming company in the world, right? Bigger than Electronic Arts. They own Activision Blizzard and all those things. So what happened to Tencent? So Tencent again was fined for a few things. Well, number one, the Chinese government blocked the merger of Taoyi and Huya. And these are the two biggest video streaming companies in China. And they wanted to merge, right, together to dominate the whole industry. And China said, no, you can't merge because that's going to be antitrust, right? So they blocked the merger, and they are both owned by Tencent. So that was slap on the wrist of Tencent, okay? Next, Tencent was fined for allowing sexually exploitive content of minors on their website, on their apps, which I think is fair, right? Shouldn't show kids doing funny things, right? And next, Tencent also owns Tencent Music. Tencent Music is China's biggest music streaming company, and it's owned by both Tencent and Spotify, right? They both own it, right? And they basically have exclusive music deals with Sony, BMG, right? They've got exclusive music deals with the US recording studios, and they control 80% of the music content in China. And the only other main competitor is NetEase. So for NetEase to play the same music, they have to buy it from Tencent, and Tencent triples the price to NetEase, which the government said that's unfair. You can't do things like that, right? You can't dominate like that. So they ordered them to end their exclusive music licensing deals, which, if you ask me, I think is fair as well, all right? Because you can't do stuff like that, right? And Tencent recently voluntarily suspended their app to new users. So new users, now they can't sign on to Tencent because Tencent realized that, yep, they need to upgrade their data security features. So they voluntarily did that. And again, because of all these things, people freaked out, and Tencent's share price, Alibaba share price, both are down like 40%. Now, if you ask me, do all these things really hurt Tencent? Does it really hurt their business model? Does it hurt their profits and sales? No. It's very, very minimal. In fact, Tencent Music only accounts for less than 1% of the sales of the profits of Tencent, right? So to me, Tencent will emerge even stronger than ever before after after the smoke clears. So I'm not concerned about my Tencent position or Alibaba position, right? Next, the government went after Didi, which I explained why, because of the way they use the data collection and cybersecurity violations. And China was really pissed off with Didi because they went ahead with the IPO and against the Chinese government's advice to delay the IPO. So the government's really pissed off, banned their apps, and said we're gonna impose very harsh punishment. Could be a big fine, could be forced delisting, no one knows, okay? But recent news has reported that Didi has now volunteered to delist from the market. They are gonna go private, right? So in other words, Didi it's over, right? But for investors, the good news is Didi may buy back their shares at the IPO price, so they don't really lose that much anyway, right? But I won't touch Didi. I never have, I never will, right? Next, Meituan. So you guys know that I bought Meituan 2 years ago at $70. I already sold everything off. Highest price I sold was $440. Meituan is a food delivery app in China, amongst other things, and I've not bought it back, right? So question is, would I buy back Meituan right now? No, because I think Meituan, unlike Alibaba and Tencent, their business model could be affected quite a bit by the new regulations. Why? Because the Chinese regulators have ordered Meituan to ensure their food delivery riders are paid a basic minimum wage, okay, and are freed from unreasonable demands placed upon them by the algorithm, so they can't get too many orders at one time, and to ensure that these workers have access to social security and are placed in a union. So by doing all this, what do you think is going to happen to Meituan? They have to pay more to their riders in terms of salary, social security. They can't give them so many orders. So will this affect the business model of Meituan? Will they increase their cost of business? Yes. So because of that, I think that Meituan's business model is fundamentally affected. And because of that, I'm not keen on buying back the shares, all right, unless they become dirt cheap, all right. So for me, Meituan is a no-no right now. Next, Chinese education companies. Basically, the long story is that the government has said, I'm sorry, but from now on, you guys can't make money anymore, all right? So you guys have to be all non-profit, and you can't offer your services on vacations. You can't offer tutoring to kids under 6. So I think this entire industry is fundamentally wiped out. So if you own shares, too bad, write it off. That's it, all right? So that's gone, okay? All right. Now, some people say, could they do the same thing to Alibaba and Tencent? I don't think so. Because the Chinese government, one of their plans is to increase domestic consumer consumption, especially in e-commerce and electric vehicles. So Alibaba is poised to benefit a lot from that. So to the Chinese economy, Alibaba and Tencent are like their crown jewels. They will protect their crown jewels. So in other words, think of the Chinese government as a father, and these are his children, right? So he's punishing his children for going against the rules, but he doesn't want to kill his children, right? He wants the children to grow up and to feed him more money, right? So I think they're safe, if you ask me. Okay, so anyway, because of all these things happening at one go, investors have been freaking out, especially Western investors who don't understand the socialist communist mindset. They say, how can the government do this? They're crazy, right? So a lot of US funds and Western investors are fleeing, selling their shares, getting out. And to me, in that kind of crisis, there's always an opportunity, right? So because of that, the market's been falling, and the Chinese government, to allay these fears that, don't worry, we're not going to kill the golden goose, right? We're just disciplining our kids. We won't kill the kids, don't worry, right? So what happened is on the 29th of July, China indicated that, don't worry, we'll continue to allow companies to go public in the US. We'll allow Chinese companies to still list on the US as long as they are not naughty, as long as they meet the listing requirements and the laws of our country. And in addition, the People's Bank of China pumped in 3.1 billion of liquidity into the financial system to support the system. So in a nutshell, I believe that every crisis will end. No crisis will last forever. This crisis will end maybe in a month, in 2 months, and 3 months. And when all the smoke has cleared, those businesses which are fundamentally good will rebound strongly and will eventually hit new highs. And to me, if you ask me, my confidence is in Alibaba and Tencent. But in terms of Meituan, I'm not too sure. Chinese education companies are gone, right? And for Didi, like I said, they're going to go private anyway. So where's the bottom? No one can predict the exact bottom, but we can take a look at certain historical trends to kind of like guess how much lower it could go. Now, this is the Hang Seng Technology Index that contains the tech companies in China. You can see during the trade war in 2018, from the top, it bottomed at a 49% drop. So that was the max drawdown at that time. And last year, during the COVID crash, it dropped 26% during the COVID crash. This current crackdown, from the top, it's down 42.9% so far. So again, could it go lower? Sure. Because remember, it went down 49% in 2018. I'm not saying it's going to go down 49%. You never know, but it could still go down another 6%. Not very good at mental math, right? It could go down 6% somewhere here, but eventually it's gonna go back higher. That's the nature of the game. Eventually it will go higher, right? So as an investor, if you're not confident about picking individual companies, you think that, what if this company, they start to, find them and they die, then it's safer to just buy the ETF that tracks the entire index. Then you've got no company specific risk, just buy the whole index, and the whole index will go higher eventually. So because we can never pick the bottom, it's always good to buy in stages. We call that dollar cost averaging, just buy a bit. So you average down, eventually it will bottom and eventually it will go to new highs. And those who have got the patience, who have got the foresight and the confidence will make a lot of money in this. There's an old saying, never waste a good crisis. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.